Listen to me very carefully, because I'm only going to say this once. And what I am about to tell you in the next 25 minutes could be the single most important financial conversation you have ever had the privilege of stumbling across on the internet. You're probably sitting there right now, somewhere between 50 and 65 years old. And somewhere in the back of your mind, there's a quiet, gnawing panic that you have been trying to drown out with television, with distraction, with the comfortable lie that things will somehow work themselves out. They will not. I have spent decades watching ordinary people sleepwalk directly into financial catastrophe. And the brutal, uncomfortable truth is that most of you watching this video right now do not have enough money saved to retire with any dignity whatsoever. The window is closing, the clock is running, and right now, at this exact moment in history, there are three specific, concrete, mathematically defensible opportunities sitting in plain sight that the financial establishment does not want you to understand, because an educated retiree is a retiree who does not need to pay a wall street advisor a fee to hold their hand. This is your last call. Answer it or don't, but do not come back later and tell me nobody warned you. If what I just said made your stomach drop even slightly, then you need to subscribe to this channel right now, because this conversation is worth thousands of dollars in advisory fees, and you are getting it for free. Every week, I break down exactly how institutional money moves, where it is going next, and how a regular person with a regular portfolio can position alongside it before the crowd catches on. Hit subscribe, hit the notification bell, and pay very close attention, because this is the kind of education that Wall Street charges a fortune for, and I am giving it away. Now, before we talk about where the opportunity is, we need to talk about where you actually are, because most people watching this video are operating on a fantasy, and fantasies are extraordinarily expensive in the years immediately before retirement. Let me give you some numbers, because I deal in numbers, not feelings. The average American household approaching retirement age has somewhere between $150,000 and $200,000 saved in total investable assets. That sounds like a reasonable amount until you run the math with any intellectual honesty. At a safe withdrawal rate of 4%, which is the standard rule of thumb that financial planners have used for decades, that $200,000 generates exactly $8,000 per year in income. That is $666 per month. That is not retirement. That is poverty with a 401 kilobits label on it. Social Security, for the average recipient, adds somewhere around $1.700 a month to that number, which brings your grand total to approximately $2,366 per month to cover housing, healthcare, food, transportation, and everything else that constitutes a human life in the 21st century. If you live in any major metropolitan area in this country, that number does not even cover rent alone. I am not saying this to humiliate you. I am saying it because the math does not care about your feelings. And the sooner you stare directly at these numbers without flinching, the sooner you can actually do something about them. The retirement savings crisis in this country is not a political talking point. It is a structural catastrophe that is going to devastate an entire generation of people who worked hard their entire lives and simply were never taught how money actually compounds and grows. You were taught to show up, to work hard, to put money into a target date fund and hope for the best. That is not a strategy. That is a prayer. And right now, in this market environment, with the specific pressures that exist in the global economy, at this very moment, there are three opportunities that are staring you directly in the face. But here is the cruel irony of all of this. The same people who cannot afford to miss these opportunities are precisely the ones who have been conditioned to dismiss them as too complicated, too risky, or too outside their comfort zone. Breaking that conditioning is exactly what this video is designed to do. And it starts with understanding how institutional capital actually thinks. Because institutional capital does not think the way your neighbor thinks. And it does not think the way your financial advisor thinks either. Wall Street, at its most sophisticated level, does not operate on hunches, does not operate on news cycles, and absolutely does not operate on the kind of emotional, reactionary decision-making that costs retail investors billions of dollars every single year. Sophisticated institutional money uses frameworks, repeatable, testable, and emotionless frameworks that have been refined over decades of market cycles, crises, corrections, and recoveries. And the framework I want to walk you through today has three distinct layers, each one representing a different type of opportunity that exists in the market right now simultaneously. Think of it this way, because the analogy here is actually important. Imagine a shopping mall with three different types of sales happening at the exact same time. On one end of the mall, there is a clearance sale, a store where the inventory is being liquidated at prices well below its actual value. not because the products are bad, but because the store needs the cash immediately and does not have the luxury of waiting for a better price. That is your first type of institutional opportunity. And in today's market, that clearance sale is happening in gold and silver. In the middle of the mall, there is a grand reopening, a store that everybody wrote off as obsolete, that closed its doors a few years ago and is now coming back because the economic conditions that killed it have completely reversed. That is your second opportunity, and in today's market, that store is cold. And I know exactly what just happened in your brain when I said that word, and we are going to deal with it. Then at the far end of the mall, there is a brand new store opening, something shiny and new and disruptive, something that is attracting lines around the block from institutional investors who understand that innovation always, without exception, attracts capital before the general public even knows what is happening. That is your third opportunity. And in today's market, that new store is biotech. Now, the critical thing to understand about these three layers is that most retail investors only ever know how to look for one type of opportunity at a time. They're either bargain hunters, or they are trend followers, or they are growth investors. The institutional framework forces you to see all three simultaneously, which is the difference between someone who captures one decent trade per decade and someone who consistently builds wealth across multiple market environments. Let me break down each one specifically. And the first layer, the clearance sale, requires understanding something that the financial media has been completely misleading you about this week. Turkey, the country, not the bird, has just panic sold 58 tons of gold in the span of 2 weeks. 58 tons. The Gulf sovereign wealth funds, the massive state-owned investment vehicles of Saudi Arabia, Abu Dhabi, and Kuwait, are pulling bullion out of London vaults at a rate that hasn't been seen in nearly 70 years. India has quietly become a net seller through its central bank. And the result of all of this coordinated simultaneous selling has been a roughly 20% decline in the price of gold. Now, here is where most retail investors make the catastrophic mistake. They see the price going down, they read the headlines about countries selling gold, and their brain files this under bad investment, stay away. That is exactly backwards from how sophisticated money thinks. The critical question, the only question that actually matters, is why are these institutions selling? And the answer is not that they have lost faith in gold. The answer is that they needed emergency liquidity. Turkey is defending its currency. The Gulf states got caught in a regional conflict to liquidity squeeze. India's central bank is managing oil import pressures. These are not strategic decisions about gold's long-term value. These are margin calls. This is forced selling. This is the financial equivalent of a homeowner selling their furniture to pay the electric bill. It does not mean the furniture is worthless. It means the seller needed cash urgently, and this was the most liquid asset they had available. When that kind of selling pressure clears, and it always clears, because emergency liquidity crises are by definition temporary, the asset returns to a price that reflects its actual structural demand. And what does the structural demand for gold actually look like right now? 95% of central banks globally have stated publicly that they intend to increase their gold holdings. The major financial institutions, Goldman Sachs, JP Morgan, Bank of America, all have price targets on gold ranging from $5,000 to $8,000 per ounce. The U.S. dollar faces sustained long-term pressure from defense spending, deficits, and the continuing global trend toward de-dollarization. None of those structural drivers have changed because Turkey needed to raise some cash in a hurry. What has changed is the price you pay to get in. You are being handed a discount on an asset that every major institution in the world wants more of, courtesy of a regional geopolitical emergency that will eventually resolve itself. Silver adds an additional layer to this opportunity because, unlike gold, which is predominantly an investment asset, silver has massive and growing industrial demand that is completely independent of the investment thesis. The world's manufacturing of silver is already running below the world's consumption of it. There are no significant new silver mines coming online. The supply constraint is structural and long-term. And when the forced selling pressure lifts from the investment side, you will have both investment demand and industrial demand pushing the price simultaneously. This is the clearance sale. The question is whether you're going to walk past it because the sign in the window says liquidation and your brain has been trained to associate that word with failure rather than discount. Now I need you to set aside whatever emotional reaction you are about to have, because the second layer of this opportunity is the one that is going to lose the most people in this audience purely because of the word I'm about to use. The word is coal. I can already see a third of you reaching for the back button, and I need you to resist that impulse for exactly 90 seconds, because what I am about to show you is a textbook example of contrarian institutional thinking. And contrarian institutional thinking is where the real money is made, Coal has been the most politically toxic investment in the world for the past decade. ESG mandates, climate commitments, regulatory pressure, and institutional divestment campaigns have collectively driven capital out of the coal sector to the point where new investment in coal mining infrastructure has been almost non-existent. Now, here's what happens when you combine a collapse in supply-side investment with a sudden, dramatic spike in the demand-side economics. Coal becomes extraordinarily valuable, and the stocks of the companies that produce it become extraordinarily cheap relative to their earnings power. Here is the demand reality that is currently unfolding in real time. Goldman Sachs is projecting oil prices at or above $100 per barrel for the foreseeable future. When oil is at that price level and liquefied natural gas prices move in parallel, coal becomes the cheapest available alternative for power generation by a significant margin. Europe, which spent the better part of the last 15 years lecturing the rest of the world about their sophisticated clean energy transition, has gas storage levels that are critically low, and their utility companies are now quietly rebuilding coal inventory ahead of what they expect to be a very active coal-burning season. The Germans, who shut down their nuclear power plants in what I can only describe as an extraordinary act of self-inflicted energy stupidity, are now running coal-fired plants because it is the cheapest option left. India, the world's third largest oil importer, has invoked emergency powers to maximize coal-fired power output to protect itself from oil supply disruptions. And here's the dimension that most people miss entirely when they think about coal. It is not just an energy story, it is a steel story. Every bridge in the infrastructure spending programs, every warship in the defense budget expansion, every railroad track, every skyscraper, every piece of structural steel that any nation on earth needs to build anything requires coking coal. There is no substitute for coking coal in the steelmaking process. You cannot electrify your way out of that reality with current technology. The infrastructure spending coming out of Washington, the defense spending increases being implemented across NATO, the reconstruction that will inevitably be required when the current conflicts eventually end, all of it requires steel, and all of the steel requires coal. Meanwhile, because of the decade of divestment I mentioned, the companies that produce this coal have not been investing in new capacity, which means supply is constrained exactly when demand is accelerating. The stocks are cheap because nobody has wanted to own them for environmental and social reasons. The earnings are growing because the world suddenly, urgently, cannot function without what these companies produce. That combination, cheap stocks, growing earnings, structural demand that no amount of policy preference can override in the near term, is exactly what institutional money looks for when it is building a position before the crowd catches on. The coal trade is not a 10-year bet. It is a cycle trade, driven by a specific set of supply and demand realities that exist right now and will persist for as long as oil remains above the price level. That makes coal the rational alternative, and the window in which you can buy these stocks before institutional inflows drive the prices higher is not infinite. The third layer is the one that gets me the most animated, because unlike the first two, which are primarily driven by external economic pressures, this one is driven by a fundamental technological revolution that is going to reshape one of the largest industries in the global economy. The industry is biotech and pharmaceutical development. The force driving the opportunity is something called the patent cliff. Between now and 2028, $300 billion worth of patents on the most profitable drugs in Big Pharma's portfolio are going to expire. And when a pharmaceutical patent expires, what happens is extraordinarily brutal from the perspective of the company that holds it. Generic manufacturers can immediately begin producing the same compound at a fraction of the cost, and the revenue that the original patent holder was generating on that drug can drop by as much as 80%. Almost overnight, $300 billion in revenue gone, distributed to generic manufacturers and theoretically to patients in the form of lower drug prices. Now, the CEOs of Pfizer, Merck, Bristol, Myers, Squibb, AstraZeneca, Eli Lilly, and every other major pharmaceutical company on earth understand this number with crystalline clarity. And they understand that they do not have internal pipeline development sufficient to replace that revenue organically within the time frame they are facing. Their only viable solution is to acquire it. They must go shopping. They must find small and mid-sized biotech companies that have promising drugs in development, drugs that are in phase 2 or phase 3 clinical trials, drugs that are close enough to approval that they can fill the gap being blown open by the patent cliff, and they must buy those companies, typically at a significant premium to wherever the stock is currently trading. The premium they are willing to pay is almost unlimited, because the alternative, watching $300 billion in annual revenue evaporate with nothing to replace it is existentially unacceptable. This creates a mathematically predictable wealth transfer from Big Pharma's balance sheets into the pockets of biotech shareholders who had the patience and the foresight to position themselves before the acquisitions were announced, and the AI dimension of this story makes it even more powerful. Artificial intelligence is reducing drug discovery costs by 40%. It is compressing timelines that used to take 15 years down to as little as 1 or 2 years. You can now develop a drug candidate with 20 researchers that previously required 1,000, which means the number of viable acquisition targets in the biotech space is expanding dramatically at exactly the moment when Big Pharma's desperation to acquire is also at its peak. Venture capital funding into biotech went up 70%, quarter over quarter in the most recent data available. Pharmaceutical merger and acquisition deal value jumped 31%. The major pharma companies have collectively committed over $480 billion toward U.S. manufacturing and research and development. The institutional money has already identified this opportunity and is flowing into it at scale. Now, here is the risk management conversation that I am legally and morally obligated to have with you. Because biotech without risk disclosure is malpractice. Individual biotech companies have approximately a 90% failure rate. That is not a typo. 9 out of 10 early-stage biotech companies fail to bring a drug to market successfully. A single FDA rejection, a single failed clinical trial, a single adverse event in a trial population, and a stock can lose 50, 60, 70% of its value in a single trading session. This is not where you put your retirement nest egg on a concentrated bet. This is where you get exposure through diversification, either through broad biotech ETFs like XBI or IBB, which give you exposure across hundreds of companies simultaneously so that the failures are offset by the successes, or through the larger, more established pharmaceutical companies that have both the pipeline exposure and the balance sheet resilience to survive setbacks. If you do want individual biotech exposure, the allocation should be treated as a high-risk, high-reward slice of your overall portfolio, capped somewhere between 1 and 5% of your total investable assets. The structural drivers here are real, the money flow is real, and the mathematical logic of the patent cliff is as close to a guaranteed catalyst as you will find in the equity markets. But you must size it correctly, or you are gambling, not investing. And the distinction between those two activities is the difference between building retirement wealth and destroying it. Let me tell you something that I have watched happen too many times, and it makes me angrier every single time I see it. There will be people watching this video today who nod along through every section, who recognize the logic in every argument, who genuinely understand for perhaps the first time why institutional money moves the way it does. And then they will close this tab and do absolutely nothing. Not because the opportunity is not real, not because the math is wrong, but because taking action requires breaking a pattern of passivity that has been reinforced over an entire lifetime of being told that investing is for experts, that the market is too complex for regular people, that you should just hand your money to someone with a license and trust them to make the right decisions on your behalf. That is the lie that has kept an entire generation of working people poor in retirement. The institutional framework I walked you through today is not magic. It is not secret. It is the same set of principles that professional money managers apply every single day in offices all over the world. Forced selling creates discounts. Structural demand shifts create sector rotations. Innovation waves attract capital before the mainstream catches on. 3 layers, 3 simultaneous opportunities. Gold and silver sitting at a discount created by emergency selling from countries that still believe in the asset. Coal coming back because the economics of energy have made it indispensable again, regardless of what anyone thinks about it politically. Biotech sitting at the intersection of a $300 billion pharmaceutical necessity and an artificial intelligence revolution that is making drug discovery faster and cheaper than it has ever been in human history. You now have the framework. You now have the thesis. The only question left is whether you are going to act on it or whether you are going to be one of the people who watches this happen from the sidelines and tells themselves they would have invested if only they had known sooner. You did know. You know right now. Do something with it. Subscribe to this channel, share this video with someone who needs to hear it, and start treating your retirement wealth with the seriousness and the urgency that it deserves, because I promise you, nobody else is coming to do that for you.